Speaking today is myself, and I'm a father, farmer, realtor, investor, coach, entrepreneur, and coach. I have 4 kids. I live in North Vancouver. I love real estate investing, and I have experience in joint ventures, foreclosures, pre-sale strategy, value add buy and rent strategy, a BRHDS strategy, which I'll talk about today. I've made that one up. A BRRRR strategy, of course, we've discussed 100% financing, and my favorite is buy and hold. My big passion in business and my mission is to help as many people as I can buy 1 to 3 investment properties in their lifetime. And the more they do early in their life, 5, 10 years later, I have never ever found a person that regrets buying an investment property. Rather, they wish they had taken my advice and doubled down more, leveraged more, and purchased more. Roland helps investors secure deals across Canada, and I'm working hard to become known as the Canada-wide investment real estate guy. So what I want to talk to you about today is a strategy that I've created. Or termed. I'm sure lots of people have done this, but what it's called is buy, rent, hold, and a developer sale. So the BRHDS strategy, what is it? It's to find a property that is dramatically underutilized with great future upzoning use. So you want to find a property at a manageable price with positive or neutral cash flow, unless in certain situations you can sustainably manage the transaction with a slight negative cash flow in order to potentially gain generous returns in the future. Of course, positive cash flow outweighs the negative, but certain opportunities come in many forms, and in certain markets such as Vancouver, there might be an opportunity to see a slight negative cash flow if the opportunity is big enough. The goal in this strategy is that in 3 to 10 years post-purchase, you're going to sell the property to a developer. The process, lots of research is required. You want to do your due diligence long before you purchase the property and make sure that you do have the right call. You want to look into city zoning, future trends, and all the information you can get. You want to choose an opportunity with the lowest chance of not being sold. And you want to see proof beyond hearsay. So, I do business in a lot of stratas where the myth is that there's this mystical buyer that's going, that's been talking to the strata about buying the whole building, and then later you realize that's certainly not the case, and there's no real process or progress that has been made. The transaction process in such a strategy is quite regular. You purchase the transaction as normal, you secure the transaction and you rent it out, and then you wait for a developer to buy you out. And there's lots of things you can do as long as you've purchased the right property to massage that exit. You would then reinvest your gains into other opportunities and rinse and repeat. So again, the opportunity is, in an ideal environment, you can buy the right property with this potential that also has cash flow. However, sometimes that's not the case, and you can still achieve an amazing windfall of a return if the transaction is realized. You will sell at a far above market price, and you'll have cash flow along the path. You'll pay down your principal, and of course, that rental income. The risk, you are purchasing a property for beyond what it's currently used for. It has potential, but you are buying something that the best and final use is still to come. You potentially are paying a premium for that property that is currently zoned or has the potential for that zone or is very close to a densification for future development, but again, it's not guaranteed. What happens if you buy a property and the zoning changes? What happens if you buy a property in a building where it feels like the neighbors are completely on board to sell, but then in the end, they don't want to sell and you don't get the numbers to realize that outcome? You have what if you have low liquidity and you want to get out before the goal is realized? So an example of this strategy that we've recently accomplished with a client was in Kerrisdale. There's a building out there, that small building, 30-unit building. If you look at that slide, you can kind of see to the right of it, there's now a tower, not a tower, but a higher building that I think is 2 stories higher. Ironically enough, when that building was built, they were paying air rights over this one, and I think they paid the strata around $300,000 just to move the crane over the building while they were building. So in this case, there was clear clear visibility of turnover and of zoning actually happening and people building between these two buildings. So it wasn't just the projection of what could happen. And in this case, in 2017, the strata received an unsolicited offer for the entire building for $24 million. It's not a 33 unit building, it's a 30. Yeah, double check. Let's say it was 33. That would have given it a valuation of about $727,000 had it sold. The strata was not interested or even aware of the option of selling, but it started a conversation. It had a lot of older owners in there, and they started the conversation of what if we sold? And is 24 million best use and best value of the land? So that triggered them to do the due diligence and have a commercial real estate firm that specializes in windups provide assessments for the building, which is 3 stories, but again can be sold for higher. The strata received an estimate from 2 of these companies in 2018, where they valued the property at $30 million. And again, that would put an average value, not all units are the same, but an average value of over $900,000 to this unit. And again, this was documented paperwork. It wasn't just, conversation of strata members saying what was happening or what potentially could happen. The building was never listed for sale because the market softened in 2018. And so the owners wanted to wait until construction of the Skyline or SkyTrain station at Broadway and Alma came to fruition. And since then, the folks in there have really started talking about being open to a sale when the time comes. So there's a real potential for a windfall with this building. We privately purchased a 1-bedroom top floor in the building for $535,000. We rented out for $19.90. Kind of at the worst time of COVID. The rent should be closer to about $22, $23. The tenant pays utilities. It is currently cash flow negative at $190. But again, if we hold this long enough and we raise the rents, we will eventually eliminate that cash flow negative. And if the tenant leaves in 2 years, we'll definitely recoup that because we'll be able to re-rent at a higher price. But even with some small negative cash flow, it has principal pay down every month of $600. So, if you took the equity, which this buyer did, he took the equity from another property and put it down as the down payment. And so it was 100% financed as well. And every single month by doing that and moving forward with this risk and this opportunity, they are $600 further ahead approximately with principal paydown. The goal is to sell the property in the next 3 to 10 years when the developer comes calling. And again, it is a unique situation where the building right beside it shows some real potential that when that development is finished, that they will be approaching the strata. So that is the BRHDS strategy.